All right, we're on the reading analysis of financial institutions. It's not a long reading, and when I say long, I mean in the sense of the content that you're expected to know. It's rather light in that respect. What makes it long, if you look at the reading, think, well, hang on a second, it covers like 70, 80 pages. It is long. There's about 20 pages in the middle that are a particular case study that is full of exhibits, so the pages turn really, really fast. I'll say more about that when we get to just before that case study in the reading. Let's begin here. LOSA. Our focus on this reading primarily are banks and insurance companies. So there we go. LOSA, describe how financial institutions differ from other companies. And we'll look at that along three dimensions: systemic importance, the nature of the liabilities, and the nature of the assets. So let's begin with systemic importance. When we say their smooth functioning, primarily banks, their smooth functioning is essential to the overall health of an economy. So if they are of systemic importance, it gives rise to the notion of systemic risk. This is a risk of disruption to financial services that is, number one, caused by an impairment of all or parts of the financial system, and two, has the potential to have serious negative consequences for the economy as a whole. And number two is based on the concept of contagion or financial contagion, that an event in one sector of the industry can have ripple effects across the entire industry, and maybe not even the entire industry, maybe not even just at a national level, but at a global level, as we saw in 2008, 2009. So because of this, financial institutions' activities are heavily regulated. Nature of the liabilities. Liabilities of most banks are made up primarily of deposits. I go to a bank, I put money in the bank. It's an asset to me. My money is there. It's a liability for the bank. Failure to honor its deposits could have negative consequences. Now, that's a line right out of the reading, and as I read it, I thought, well, of course it could have negative consequences. If I go to the bank and they say, well, we don't have your money to give to you, that's a negative consequence. It really should say could have wider negative consequences, and that is a loss of faith in the banking system. So I come home and I say, they didn't have my money. They said, we don't have any money on hand. Somebody else says, I have my money in that bank too. So next morning they're in line. Hey, I want my money. And then more people want their money. And then your neighbor thinks, well, it's not my bank, but if it could happen at your bank, it could happen at my bank. I'm going to go to the bank and I want my money back. Well, suddenly banks all have to meet their liabilities all at one time. But all those liabilities are in assets. Assets in the form of loans. So yeah, that becomes a big problem, right? So because of that, deposits are often insured. So that I think, well, hang on there. You haven't got my money. I know I have insurance. So I'm good. I don't have to run to the bank to get my money out. I'm insured on this one. Nature of the assets, predominantly financial assets versus tangible assets. So we think of most organizations we look at, property, plant, and equipment. Banks really don't have that. The vast majority of their assets are financial assets. And for banks, what's the biggest thing that they do? What are they in business for? Lending money. So loans become a big part of their assets. This creates direct exposure to specific risks, both with their assets and with their liabilities. Interest rate risk, credit risk, market risk, liquidity risk. And one more point regarding the nature of the assets, often measured at fair market value for financial reporting. We'll see a little bit of this later on when we start looking at how we would analyze a bank, so I won't say much more about that. LOSB, describe key aspects of financial regulations of financial institutions. And on the previous screen, we talked about the systemic importance of banks, and that because they're systemically important, it gives rise to something called systemic risk. Well, that's the goal of regulation. It's to minimize systemic risk. The harmonization and globalization of regulatory rules. This is to promote consistency of standards and regulation to help minimize regulatory arbitrage. And in the last reading in the economics section, economics of regulation, we talked about regulatory arbitrage. The big boy on the block, and when I say the block, I mean the planet, the big boy on the planet that's focused on financial stability is something called the Basel Committee on Banking Supervision. And the latest incarnation of the regulatory framework is called Basel III. And within Basel III, there's some things that we should be aware of. Standards for minimum capital requirements, minimum liquidity, and stable funding. So minimum cap, we'll see all of these a little bit later on as well. We're just going to highlight them here at a very high level. Minimum capital requirements. This is the minimum percentage of the risk-weighted assets that a bank must fund with equity capital. We will define risk-weighted assets as we go through the content. So it's the percentage of the risk-weighted assets that a bank must fund with equity capital. We will also define different tiers of equity capital. So our work is cut out for us there. Minimum liquidity. A bank must hold enough high-quality liquid assets to cover its liquidity needs in a 30-day liquidity stress scenario. And stable funding. This is the amount of stable funding relative to the liquidity needs over a 1-year horizon. Stable funding means from sources that are more stable as opposed to short term. So we know that banks can engage in the interbank market and get overnight loans. That's not considered stable funding. Certain types of deposits from customers, depending on the type of customer they are more stable than others. We will define stable funding a little later on as well. We're really just introducing the concept of regulation, and these are the three big ones we're going to pay attention to. So before we leave LOSB onto LOSC, which is halfway down the page here, stable funding, longer term deposits and consumer deposits are considered more stable versus short-term deposits or interbank funds. Basel III has forced banks to focus on asset quality, hold capital against other types of risks, and develop improved risk assessment processes. LOSC. This gets into the heart of it, and we're going to be with LOSC for a while. And as we go through LOSC, we're going to refer to the exhibits as we go through this reading. And the exhibits deal with HSBC. The roughly 20 to 22 page case study in this reading deals with Citigroup. I'm not going to go through it. I've read through it. It is rather simplistic. It is easy to get through. It is not taxing at all, but trying to get through 20-some pages on the screen is difficult. I have done a pass-through of it, and I've rewatched it, and I thought, okay, it's hard to follow what's going on because there's just so many charts to look at that it's easier just to read it and look at the charts yourself. It really, those 20 pages might take you 15 minutes to get through, and it's not cognitively difficult at all. In fact, it's rather light and easy to get through. So I leave that to you. But we will do HSBC. We'll do a walkthrough of all of the exhibits for HSBC. And the Citigroup thing is just a repeat, just using a different company. That's all it is. So let's begin. LOSC, explain CAMELS, C-A-M-E-L-S. C for capital adequacy, A for asset quality, M for management, E for earnings, L is liquidity, and S is sensitivity. So these are the 6 things that we want to look at. Explain the CAMELS approach to analyzing a bank, including key ratios and its limitations. So on the previous LOSB, when we looked at Basel III, the first thing we looked at was minimum capital requirements. The first thing we're looking at here is capital adequacy. So we're going to see that this does tie back to some regulatory standard. So let's go. Capital adequacy is defined in terms of the proportion of the bank's assets funded with capital. Assets are adjusted based on their risk. Riskier assets require a higher weighting. So cash has a weighting of 0%. So imagine that you have assets of 100 million all in cash. Since you have 100 million all in cash at a weighting of 0, it would be considered, well, you got 0. You don't need any equity to back that. It's cash. If somebody showed up and said, hey, I want my 100 million back, if you have liabilities of 100 million, somebody want their 100 million back, well, you got it. So you don't need any equity to back that. That's the notion behind weighting cash as 0. Corporate loans, you need 100%. Or sorry, not 100%. They're weighted as 100%. So the asset itself is weighted as 100%. So $100 million in corporate loans would be considered $100 million in assets. Others could have a weighting greater than 100%. So for example, a non-performing loan. It's not written off yet. It's just non-performing. Might be weighted at 150% or 175% of its value. So if it's 100 million, it would be weighted at 150 million. So clearly we would need more equity to back that type of asset. So we said that one of the, if you look at the top of the screen here, one of the consequences of Basel III is it's forced banks to focus on asset quality, simply because of the way that they define the assets. They're now not just the sum of your assets, but they're risk-weighted assets. So these kind of assets, these non-performing loans, are assets of low quality. Suddenly you need a higher capital amount, and we'll see exactly how much capital we need, the minimum capital we need, but you need a higher capital amount to back those type of assets. Clearly, corporate loans make a lot more sense because we need to earn a return. Well, we're going to earn interest, and we don't earn anything on cash. Obviously, we want to put some loans out, but we want loans out to companies that'll pay us back. They won't turn into non-performing loans. So there's our job. You can see that having a measure and some minimum requirement that's a standard does force a bank to focus on its asset quality because it wants to have the least amount of risk-weighted assets possible. 100% makes sense. Anything less than 100 is nice, but not as profitable. But anything over 100%, like these non-performing loans, well, then that's just a drag, right? All right, let's look at capital. We've got sort of a nice little idea of the assets. And we'll look at capital, and we'll look at some exhibits. Don't worry, we'll walk through some exhibits for all of this. We're just getting the language and the definitions out now. Capital classified into hierarchical tiers. There are 2 tiers, tier 1, tier 2. The most important is the common equity tier 1 capital, and then there's something called total tier 1 capital. So let's look at what common equity tier 1 capital is. We'll define it down here first. So let's go from this statement down to here. It includes common stock, surplus over issuance value. This is so if you have stock that has par value of $20 and you issue it at $30, your common stock would have the par value amount in it. The surplus over issuance would have the other part of it in there. Retained earnings, accumulated other comprehensive income, and then you have some adjustments. So we have deductions for intangible assets and any deferred tax assets. So that is our tier 1 equity capital, and it must be at least 4.5% of our risk-weighted assets. That's a minimum capital adequacy ratio, at least 4.5% of our risk-weighted assets. Total tier 1 capital must be at least 6% of risk-weighted assets. What's the difference between moving from common equity tier 1 to total tier 1? For total tier 1, we can look at other forms of equity that are not included in tier 1. The big one is any subordinated security, like a preferred share, that has no maturity date. So perpetual preferred would be considered in total tier 1 capital, but it is not common equity tier 1 capital. It would be considered in total tier 1 capital, with a little caveat. And here's the caveat, that the dividend on the perpetual preferred must not be contractual, it must be discretionary. In other words, management must have the right to cancel that dividend without there being an issue. And if that's the case, well then, as long as the instrument itself is very low on the claim against any liabilities, in fact it's last on the claim, ahead of common equity, it still would count as tier 1 capital. Total tier 1 capital must be at least 6% of the risk-weighted assets. So tier 1 capital, whether it be common equity or total, is the most loss-absorbing form of capital. The rationale behind having these minimum capital ratios is it is the most loss-absorbing form of capital, and it places shareholders' funds at risk of loss first, as opposed to socializing the losses. Like that was the argument in the financial crisis, was that, hang on a second, we're making the taxpayers pay for all the losses now. We've privatized the gains to investors, but now we're socializing the losses. So if we have some minimum equity that must be held, then whenever there's losses, that group gets hit first. Tier 2 capital, instruments that are subordinate to depositors and to general creditors, plus an original minimum maturity of at least 5 years. So this is preferred. You can think of preferred shares again, but these preferred shares can have a maturity date. If they were perpetual preferred, then they would count in the tier 1 capital. If they're not perpetual, but they do have a maturity date, an original maturity date of greater than 5 years, they can count as tier 2 capital. Total capital, that's the sum of total Tier 1 and total Tier 2. Total capital must be at least 8% of risk-weighted assets. So we have common equity Tier 1 capital at least 4.5%, total Tier 1 at least 6%, and total capital at least 8%. All right, let's look at Exhibit 1. All right, here we are. Example 1. I said Exhibit 1. I meant Example 1. Exhibit 3 presents an excerpt from an annual report disclosure by HSBC Holdings about its capital position. The expert shows the group's capital ratios, amount of capital by tier, and risk-weighted assets by type. What do we have here? Our capital ratios, common equity Tier 1 ratio, 13.6 versus 11.9, so it's improved. And the minimum is 4.5. We're well above that. Tier 1 ratio, 16.1 versus 13.9. It has improved as well. And the minimum is 6. We're well above that. Total capital ratio, 20.1 versus 17.2. Minimum is 8. We're 2.5 times better than that. So we have an improvement in the ratios. So the question then becomes, well, is it that we have more capital? Or is it that we have fewer risk-weighted assets? We have better quality assets, for example. So which one is it? Let's have a look at the numbers for each one here. So this is total regulatory capital, and here's our risk-weighted assets at the bottom. So let's see what we have. Common equity Tier 1 capital, 116,552 versus 130,863. So it dropped. We have less. Additional Tier 1 capital, 21,470 versus 22,440, so it dropped as well. And total Tier 2 capital is 34,336 versus 36,530, so it dropped as well. So we actually have, in raw numbers, decreasing capital in terms of total dollar value. So to get our ratios higher, we must have had an improvement on the risk-weighted assets, either less risky assets altogether or fewer assets altogether. So our risk-weighted assets were 857, 181, so that's how we get our ratio. Let's have a look at what we have down here. Our risk-weighted assets, it just gives us a total amount by type: credit risk, counterparty credit risk, market risk, operational risk, and the capital required. So all we do to get our capital requirement is we take our assets, we multiply by 8%, because that's how much capital we need to back it, 8%, and this will be the requirement. So we really only required 68.6 out of that 857. We got 172 point, if you look up here, 172.3. Based on Exhibit 3, did HSBC's capital ratio strengthen or weaken in 2016? Well, we saw that it strengthened. We don't have to go much into detail about that, and I don't think we need to read the answer. The answer is just going to compare number over number. Based on Exhibit 3, what was the primary reason for the change in HSBC's capital ratios in 2016? Well, the primary reason for the change, we can't say that it was a change in capital because the capital decreased. It should have made our ratios lower, but our ratios were stronger. So the primary reason that they were stronger must have been on the asset side, which means that we had either a higher quality of asset, maybe moving more towards cash over those previous over last year, or releasing or getting rid of or moving out a whole bunch of underperforming assets. Maybe that's it. So there we go. All right, we're done the C. Let's go on to the A, asset quality. This pertains to the amount of credit risk associated with the assets. And there are two big categories of assets we should be aware of. These are loans and investments in securities issued by other entities. So for loans, you'd want to consider the creditworthiness of the borrowers, the adequacy of the adjustments for expected loan losses. Loans are measured at amortized cost. They're shown net of allowances for loan losses. By amortized cost, that simply means that if you put out a loan for $2 million and over the course of the year $100,000 in principal was paid down, then it's $1.9 million. It's not really saying a lot that doesn't already make a lot of sense. Investment in securities issued by other entities. We've been through this in another reading in FRA. IFRS and GAAP treat them differently, although I have tried to line them up in terms of how they are related. IFRS treats them as either amortized cost, fair value to P&L, or fair value to other comprehensive income. GAAP, held to maturity, which is in line with the amortized cost treatment from IFRS. This is debt only in GAAP. Equity must be in this category here, held for trading. This is treated the same way as fair value to P&L, so debt and equity can be in the held for trading, or available for sale, which are debt securities. Let's do a walkthrough of example 2 and 3. All right, example 2, asset quality. Composition of assets. Exhibit 4 presents the asset portion of the balance sheet of HSBC Holdings, which is prepared according to IFRS. So here we are, assets, a whole bunch of categories of them, but we should be able to, as we read down, broadly recognize what each one is. Cash and balances at central banks, well, that's cash on hand, right? Items in the course of collection from other banks. This is just overnight clearing. I deposit a check into my bank, and I'll get my bank account will rise with the balance today. So the bank's liability increases, but it hasn't got the money yet. It has to clear through the system. That's all that is. Hong Kong government certificates of indebtedness. Trading assets, financial assets designated at fair value. These are financial investments, 2 categories of financial investments. Derivatives. Being that this is a bank and that it's a global bank, I would say that it's primarily interest rate and currency derivatives. Loans and advances to banks, well, that's part of their loan book. Loans and advances to customers, that's what they're in business for. We should see the highest asset value there, 861,504, and if we scan down, it is the largest entry. Reverse repurchase agreements, non-trading. Well, we know what a repo is. A repo is I come to you, I give you a security, you give me money, and the agreement is I'm going to show up tomorrow and buy it back for a little bit more. From your perspective, that's a reverse repo. It's you're lending me money and you're holding collateral. So that's all this one is. Financial investments, well, that goes with these 2 up here, trading assets and financial assets designated at fair value. Assets held for sale. This is not available for sale financial investments. These are just assets held for sale. Prepayments, accrued income, and other assets. Well, this is something we'd expect to see on even non-financial companies' balance sheets, just prepaid expenses or any prepayment. Current tax assets, and if we look down, we see deferred tax assets. So there's a current portion and a longer-term portion of tax assets. Interests in associates and joint ventures. Well, investments in associates, we've already seen that at level 2. And goodwill and intangible assets. So there we go. We can read all of these. We know what they are. What should stand out is the predominance of the financial assets and the almost non-existence of physical assets. The following items are the most liquid. Cash balances at central banks, items in the course of collection from other banks, and Hong Kong government certificates of indebtedness. What proportion of HSBC's total assets was invested in these liquid assets in 2015 and 16? Did balance sheet liquidity decrease or increase in 2016? Well, that's a juvenile thing for us to do, right? It's basically telling us these first 3, what percentage of this is over the total. So that's, I mean, it's not really challenging to do. Let's have a look and see what the percentages were. In 2015, 5.5%. In 2016, 6.9%. So clearly liquidity has improved. Number 2, how did the percentage of investments to total assets change from 2015 to 2016? Include trading assets, financial assets designated at fair value, and financial investments as investments. So the 3 categories that we saw. So the trading assets, the financial assets designated at fair value, and finally these ones down here, financial assets. And again, all it's saying is add them up and divide them by this total and tell me what happened. So let's look at the answer to 2 here. So 2015, we add the 3 up, divide by total assets, 28.1% versus 29.3%. So more of our HSBC's assets have moved in to financial investments. And finally, number 3, what proportion of assets are loans? As noted, the bank's loans include loans and advances to banks and loans and advances to customers. In addition, reverse repurchase agreements are a form of collateralized loan. So we have the three categories. So in 2015, loans represented 48.2%. And in 2016, what do we get? 46.8%. So it's decreased. What the bank is in business for is actually representing a lower amount of their total assets. All right, let's have a look at example 3, credit quality of assets. Exhibit 5, which is below, presents an excerpt from an annual report disclosure by HSBC Holdings about the credit quality of its financial instruments. The exhibit shows the distribution of financial instruments by credit quality. And there's a little bit of extra detail in here, this next paragraph, that we really don't need to read to understand what's going on. It just gives us a description of the composition of the numbers that we're going to see, but we can go right to the numbers here. So what do we have, or at least this is what we should expect to see when we get there. Exhibit 5, excerpts from the annual report disclosure. Neither past due nor impaired, so you have strong credit quality, good credit quality, satisfactory, and substandard. And here's the distribution of the assets from 2015, 2016. Past due but not impaired, and then impaired for total gross amount. And then from that, we're going to have an impairment allowance. Which, if you think, well, you've got 2510 that's impaired, but we're only going to make an allowance for 8100 of it. The previous year was 28058, but there's only an allowance for 11027. So you'd probably, if you're interested in this kind of stuff, you'd probably say, well, is there some rule for the impairment? Is there some rule of thumb they follow, or some formula they follow? Why, if 2510 is impaired, we would only have an allowance of 8100? And it could be that, it's well known in the industry that impaired assets get sold off to collectors, and they pay this much on the dollar, or that historical collection rates say that you'll recover this much in terms of loss given default, etc. That's where the experience with the industry comes in to know whether or not is 8100 a respectable number to use, considering an impaired amount of 2510. I don't have the experience in the industry to say whether or not that makes sense. So let's go. Based on Exhibit 5, did the credit quality of HSBC's financial instruments improve or deteriorate in 2016? Specifically, how did the proportion of assets invested in strong credit quality instruments change from year to year? I see proportion. I'm looking at this. I'm saying, well, the best way to determine that, it gives it away with the word proportion, is to turn everything into a percentage of the total gross amount. So all I'm going to do is I'm going to take each one of these numbers divided by the total gross amount and rewrite these in terms of percentages, which is exactly what they do. So here we are, strong credit quality, 69.2% of assets, now it's 71.4%. And that's the big category. 71.4% of our assets are strong credit quality. We can say that has increased. Good credit quality, 14.7 to 14.2. If strong credit quality is increasing, we would expect to see some of these other categories decrease, right? Satisfactory, 13.1 to 11.9. That's a nice drop. Substandard credit, 1.2, pretty much stayed the same. Past due but not impaired, 0.6, dropped to 0.4. Impaired, 1.2, dropped to 0.9. Well, we would expect that. Again, if we're pulling a bunch of weight into the strong credit quality category, the rest should drop, right? So what do we have? Impairment allowances, 0.4%. We had 0.5, we have 0.4. We actually have lower impairment allowances, but we also have a higher percentage in higher credit quality, right? Let's look at number 2. Based on Exhibit 5, does the change in HSBC's impairment allowances in 2016 reflect the change in the credit quality of financial instruments, specifically the amount of impaired assets? And I guess what I would look at here, I guess the most logical way to look at it is to say, well, in 2015, if you had 11,027 as your impairment allowance of the 28, what percentage is that? And are we maintaining the same percentage? Because I'm going to assume, well, there must be some recovery rate that's probably fairly standard in the industry. So if this was like 40% of this number and this is 40% of this number, then I can say, well, it doesn't seem like any extra decisions were being made there. Let's see how it's handled here. Based on Exhibit 5, the change in HSBC's impairment allowance in 2016 reflects the change in the credit quality of financial instruments. In general, it is expected that the amount of impairment allowances will be related to the amount of impaired assets. Well, yeah, okay. That's not a controversial statement, I think. The 26.5% decrease in the amount of HSBC's impairment allowances in 2016 corresponds to the 26.9% decrease in impaired assets. Okay, so they're looking at it as a decrease year over year. As a corollary, the amount of impairment allowances as a percentage of impaired assets remain roughly constant in both years. You had 39.3% for 2015, 39.5% for 2016. So the impairment amount, or the allowance for the impairment amount, actually creeped up 0.2% year over year. So it actually became a bigger percentage of the impaired assets. So I don't think I'd see any red flags there. But again, if I had industry experience, I would probably look at that and say, well, at 40%, that's in line. That's in line with everybody else, and that's pretty much in line with known recovery rates. But I don't know that. All right, C and the A are out of the way. Next is M, management capabilities. And we would assess management capabilities here pretty much the same way you'd assess it at any other company. What kind of performance did management bring in for the quarter or for the year? How good were they at identifying profit opportunities while managing risk? And of course, lots of risk here: credit risk, market risk, operating risk, legal risk. Have a look at their governance structure. Did they have a strong governance structure? Sound internal controls? And you would make an assessment of their financial reporting quality. So here the M, yes, it's a necessary component, but the M is no different than the M that you would use anywhere else for any other company. So this is not, I guess the point is, it's not unique to financial services industry, companies. It's just something you would do. All right, let's look at the E, earnings. A couple of things we want to pay attention to. The type of earnings, high quality and trending upward, is what we want to see. We want to see sustainable rather than non-recurring earnings. Three big categories of earnings we'd like to look at: net interest income, service income, and trading income. The trading income is the more volatile component, so we want to see good, healthy net interest income and good service income. Typically, this will be your biggest category. Reliable estimates of loan impairment allowances and estimates of fair value. If all the assets are listed at fair value, how did we arrive at those estimates of fair value? For that, we do have a fair value hierarchy, categorized on the basis of the types of input used to establish fair value. So it gives us some idea of how comfortable we can feel with the values that are reported. Level 1, inputs are quoted prices. Well, there you go. It is what it is. So if there is a particular bond and there's an active market for it and there's a quoted price and we say this is the fair value as of yesterday's closing price, well then there's nothing worrisome about that. Level 2, observable but not the quoted prices for identical instruments in active markets. So in other words, we can observe a price in an active market for an instrument that is very much like the one we have. We just can't observe a price for the one we have. So it's not an identical asset, but it's close enough and it's observable and it's in an active market. So level 2 can be actually of two types. Maybe similar instruments in active markets or identical instruments in non-active markets. And of course, we would take whatever input we have. That becomes our input. If we have a similar instrument in an active market, we can take that particular price, or we could take the price that's in the non-active market for the identical instrument, combine it with interest rates, credit spreads, volatility as inputs to a model to estimate fair value. And level 3 fair value amounts, these are unobservable. So fair value is based entirely on a model. Let's look at example 4. All right, example 4, composition of earnings. An analyst has gathered the information in Exhibit 6 to evaluate how important each source of income is to HSBC. So here are the three big ones: net interest income, net fee income, net trading income. And we should expect net interest income to be the biggest one. That's what they're in business for, right? Borrow money at low amounts, lend it at high amounts. And we see in each year that it is the largest of the three. Net fee income, we can see is the second largest, and then you have net trading income. Net income or expense from financial instruments designated as at fair value. Next is gains less losses from financial investments. Dividend income, net insurance premium income. We have another category here that only showed up in 1 year. Here's other operating income or expenses and total operating income. 2012, 2016, look at this, 82.5, 78.3, 74.6 roughly, 71, 59.8. So it is going downward. Based on Exhibit 6, what is HSBC's primary source of operating income? And what proportion of total operating income was earned from this source in 2016? Well, we've already said it was net interest income. All we do is we take the 29,813 divided by the 59,836 to answer the first question, which is what they do here. 49.8% of total operating income was earned from net interest income in 2016, roughly about 50% of their income. Based on Exhibit 6, what proportion of total operating income did HSBC earn from trading income in 2016? Trading income was their second biggest category. It was 12,777. So again, it's just division, right? What do we get here? 15.8% of total operating income from trading activities. So between the two, roughly 65% of their income comes from those two activities. And number 3. Based on Exhibit 6, describe the trend in HSBC's operating income. Well, we've described the trend. It's sort of downward sloping. The best way to look at any kind of trend or do any kind of trend analysis in the components is always a common size income statement. So that's what they do down here is they put it into common size. So net interest income, we can see 45.6, 45.4, 46.5, 45.8, really hugging the 46% line, and then we have a jump almost to 50% here. Net fee income 19.9, 21, 21.4, 20.7, 21.4, sort of hugging the 21% line. Net trading income 8.6 up to 11.1, down to 9.1, up to 12.3, up to 15.8, and we said earlier that it is the most volatile component, and we can see here that it is volatile. So in assessing the quality of the earnings, well, first of all, the trend is downward, yes, but we can still make an assessment of the quality. We want to see performance from net interest income and net fee income being the majority of the income and stability in it, and I think we do see that kind of stability. What comments do we make here? From 2012-2016, HSBC's operating income declined each year. The composition of operating income was fairly constant from 2012 to 2015, with around 46% from net interest income, 21% from fee income. So we can see that there's nothing. The proportions seem to be in line. The question is what's going on here, and why is that shrinking over time? All right. Now we're on to L, liquidity position. There are two minimum liquidity standards from Basel III. There are other liquidity standards, two minimum ones, and the ones we're looking at here from Basel III. The liquidity coverage ratio, LCR. This is the minimum percentage of a bank's expected cash outflows that must be held in highly liquid assets. So our numerator here, highly liquid assets, assets easily converted to cash. Denominator here is 1 month liquidity needs in a stress scenario, should be 100%. The second ratio is the net stable funding ratio. This is the minimum percentage of a bank's required stable funding that must be sourced from available stable funding. And it's just a ratio of available over required. In other words, what are the available sources of stable funding we have? And what are the required needs for stable funding? And this ratio here should be greater than 100%. So the net stable funding ratio is a function of the composition and maturity of the bank's funding sources, that's our numerator, and the bank's asset base, that's our denominator. So the numerator for the funding sources available, we assign capital and liabilities, because that's where we get our funding, right? We get it either from equity or from customer deposits. We assign our capital and our liabilities to one of 5 categories, and then we multiply by an ASF factor, an available stable funding factor. We'll look at example 8 in a second. Our denominator, the required, that's the bank's asset base. Loans with long dated maturities require stable funding. Highly liquid assets do not. All right, I meant exhibit 8, not example 8. Here is a little bit more clarity on the ASF factor, the available stable funding factor, and the components of the ASF category for each one, and we can see a factor here of 100%, 95, 90, 50%, 0%, and what's included in them. I'm not going to torture you by reading out each of the categories. It's just a nice exhibit that sort of gives us a little bit more clarity instead of having this abstract idea of, well, what do you mean an ASF factor? How is that determined? How do we arrive at that? What is in each of these categories? So this is, for the interested, a good exhibit for reference. But again, I'm not going to read each line for you. I think you can do that. So we're going to wrap up LOSC on this screen. You can see LOSD down here. We'll start that. We have two examples to get through, example 5 and example 6. We'll finish up liquidity position here and look at sensitivity to market risk. So other things we look at under liquidity, the concentration of funding. This is the proportion of funding that is available from a single source. And we'll look at the contractual maturity mismatch, maturity date of assets compared to the maturity dates of funding sources. And for banks, let me give you an example of a really, really easy bank to set up. Even you can set up one of these banks, but it's an extremely risky bank to have. So let's just take a normal upward sloping yield curve in any upward sloping environment. What you can do, if you have the ability to do this, is borrow short-dated debt and invest in long-dated debt. And there you go. There is your your net interest income. Whatever you're going to earn on the long-dated debt, less whatever you're paying for your short-dated debt. Here's where the problem arises: is what happens if you can't roll over your short-term funding at a certain point? You're out of business. What happens if interest rates start to rise? Your net interest income is going to get squeezed very badly. You have a massive mismatch between the maturity date of your assets and that of your funding sources. So being that we've set up this hypothetical very, very risky bank, it may be worth looking at other banks in terms of that maturity mismatch as well. Let's look at example 5, and we'll come back and we'll finish up with our letter S. All right, example 5. The following excerpts from HSBC's annual report explain the bank's approach to management of its liquidity and funding risk. The disclosure states that the group's principal operating entities were within the risk tolerance levels established by the board for the liquidity coverage ratio, the net stable funding ratio, depositor concentration, and term funding maturity concentration. And there's a lot of words here. We're really not going to read these. We're just going to scroll down and look at the exhibit that they provide. And here is the LCR and the net stable funding ratio. So let's look at what we have here, December 15th to December 16th. Anything over 100% is good. We want it to be 100%, so anything over 100% is good. Anything less than 100% is bad. Don't really see anything jumping out. HSBC Bank China has the highest at 253. And for the NSFR, we would like that to be over 100% as well. And as we scan down, everything seems fine, except we have a problem here in China with the available sources of stable funding versus the required sources of available funding. So let's see what we have here. Based on the exhibit in 2016, which of HSBC's operating entities had the highest level of liquid assets relative to its liquidity needs in a stress scenario? Well, that was China. Based on the exhibit, which of HSBC's operating entities had the most stable funding relative to its required need for stable funding? Here, you're just looking for the highest entry. What do we get? We have a 162 over here. Hang Seng Bank, anything higher than 162? Nope. Okay, there we go. And based on the exhibit, which of HSBC's operating entities is the furthest away from achieving the Basel III target for the stable funding ratio? And that would be HSBC China. That's it. And finally, the S, sensitivity to market risk. And here we're looking at the sensitivity of earnings to an increase or a decrease in interest rates or exchange rates or whatever risk factor they have exposure to. Disclosures of this type are typically found in annual filings. There'll be an exhibit which says, well, if interest rates went up 100 basis points or down 100 basis points, here's what would happen to our net income. And we see this in example 6. So let's have a look at that, and we'll wrap up LOSC. All right, here we are, market risk. The following excerpts from HSBC's annual report explain the bank's approach to monitoring its market risk and illustrates one of the tools used by the bank, sensitivity analysis. And again, the excerpt, we're not really going to read the excerpt. I find that it's difficult to follow when I read it on the screen. I'll allow you to read that. Let's just go right to the exhibit here. And what do we have? We have a change in 2016 net interest income. So it's only the net interest income arising from a shift in the yield curve of, we have 25 basis points at the beginning of each quarter. So that's 100 basis points over the course of the year, and minus 25 basis points at the beginning of each quarter. And we can see what would happen to our net interest income in each of those particular scenarios. So in any particular year, you can sort of judge whether or not the central bank is in a tightening, a hold, or a loosening policy position. And this helps you determine over the course of the year what would happen. Now, we're seeing that we have 25 basis points at the beginning of each quarter of interest rates are going up, that the income, the net interest income, is actually increasing at this point in time. And that's because assets typically are greater than liabilities. So if your assets, if interest rates are going up, well, that's what you earn interest on, are your assets. So you would actually end up making more, and this is consistent with that. Number one, based on the exhibit, by how much would HSBC's planned net interest income decrease if the yield curve shifted downward by 25 basis points at the beginning of each quarter for 4 quarters? Well, it would just be, we have the total. They're already giving us the totals here. So all we would have to do is just add across. We have our final column here is total 2406. HSBC's planned net interest income would decrease by 2,406 million, 2.4 billion, if the yield curve shifts down by 25 basis points at the beginning of each quarter. And 2, if a decrease in interest rates would hurt the earnings of banks such as HSBC. Why would central banks lower interest rates so significantly following the financial crisis in order to prop up the financial sector? And for the alert ones that we're looking at this, saying, well, yeah, hang on a second, that does make sense, right? If a lowering of interest rates hurts bank profitability, and you want to try to prop up the financial system, why would you do that? And let's remember what a central bank is to other banks. It is the lender of last resort. So if all sources of funding for a bank dry up, it can go to a central bank. Well, if central banks make money really, 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 really cheap, well, suddenly their source of funding is super, super cheap. So even if the rates came down on their assets, their source of funding, their lender of last resort funding, is super, super cheap. It's almost a license for a bank to print money. It can put out loans to very, very good customers at very attractive rates and still make money without thinking very much about it. Let's see what kind of solution they provided for that. An interest rate sensitivity table such as the one presented by HSBC is a static presentation and thus assumes that the relation between the structure of assets and liabilities in place at the time would remain stationary. Following the financial crisis, the central bank's actions reduced interest rates at which banks could borrow, effectively to near zero, while the rates that banks were able to charge their loan customers were, while still low, far higher than their borrowing costs. Further, the central bank's actions were not intended solely to prop up banks' earnings, but also to provide liquidity and stimulus to the overall economy. All right, LOSD. Describe other factors to consider in analyzing a bank. And we'll look at 2 categories of other factors: banking specific factors under other relevant factors, and non-banking specific factors to look at. Number 1, government support. It is in the government's interests to have a healthy banking system. So if you're an investor in a bank, right away you think, well, the government's on my side. Things go wrong, government's on my side. This is where we get concepts such as too big to fail, or something called a SIFI, systemically important financial institutions, when a bank gets so large that it cannot fail. It is too big to fail. You can sort of look at that and say, well, you know what, even in bad times, government's going to step up and do something. All right, next, government ownership. We have government support. Let's move right to government ownership. This is a dimension of security for investors. We can take two views of government ownership. There is the development view and the not development view. Development view, ownership aids financial development of banks, leading to broad economic growth. The other way of looking at it is the banking system is simply just not strong enough to stand on its own. If there is government ownership, government is more likely to intervene on the bank's behalf in the event of economic distress. We look at the mission of the banking entity. This is more of a qualitative assessment. I think there's more distinction when you're looking from regional to national to global. The big difference between, let's say, a regional and a global bank is their exposure to a particular type of loan. Diversification versus concentration of loan exposure. So, for example, if we take banks in Canada, and let's say there was just a regional bank specific to just Alberta, we would naturally expect it to have heavy exposure to agriculture and oil and gas. If we look at banks in the U.S., let's say in Ohio or Indiana, just a regional bank, we would expect them to have heavy exposure to agriculture, versus a global bank, which would be more diversified across industries, across countries, across sectors. The corporate culture, risk-averse and cautious versus risk-seeking. A risk-averse and cautious culture, you might generate inadequate returns. Versus risk-seeking, you might end up with this boom and bust results volatility, where earnings are very high, then they're very low, then they're very high. And that volatility adds uncertainty, which means you have a higher discount rate on those future cash flows. All right, the second group of factors we'll look at are non-bank specific factors. Sort of a checklist that you would look at almost with any company you'd be looking at, right? The competitive environment. You do some sort of competitive analysis, whether the bank or the financial institution is operating regionally, nationally, or globally. Any off-balance sheet items, these are non-recognized liabilities that still provide a creditor with a claim on future cash flows. We've already discussed in one of the previous readings in FRA the variable interest entity. Typically, there'll be consolidation. If there is no consolidation, or if it avoids consolidation, there will be disclosure. Pension benefit pension or benefit plans. And even though the net pension asset or the net pension liability is on the balance sheet, the total assets do not show up on the balance sheet. So you'd want to assess any potential shortfalls in the assets due to market performance, and if the asset base is very large in relation to the organization, well, then that could be a dangerous situation. And assets under management, this is more for financial services companies that do manage investments. While the assets do not belong to the organization, the assets are a driver of fee income. Segment information. Currency exposure. This is more of an issue for global banks. A list of risk factors, obviously, and this one is rather curious. The last one, Basel III disclosures. It's in the category of non-bank specific, yet this is very bank specific, it seems. Basel III disclosures, there's for what needs to be disclosure, there is a requirement for very extensive disclosures. All right, we're on our last learning objective, LOSF. We skipped over LOSC, analyze a bank based on financial statements and other factors. And as I said at the opening of this particular reading, there's about a 20-page section of this particular reading that walks you through Citigroup. And it's not a difficult 20 pages to get through. It's a very light walkthrough. I leave that to you only because I have laid it out on the screens and then rewatched it, and it's just confusing and difficult to follow when it's on the screen. It's just so much easier just to walk through it and read it yourself. The majority of those 20 pages are full of exhibits that you don't really have to know the whole exhibit, just specific points of it. But if we've walked through HSBC, which we have, it's just a repeat of that. So let's move on to insurance here. Describe key ratios and other factors to consider in analyzing an insurance company. And I could just go right to the key ratios and be done in about 2 screens. But I've decided to take 6 screens to do this, only because we'll understand the ratios a lot better if we have some background on insurance companies, the difference between property and casualty and life and health, because you're going to see this at level 3. And at level 3, you dive more deeply into the types of insurance companies and the two types to understand the asset allocations that are required to support the liability. So a little more background now makes it easier when you get there. So let's begin. Insurance companies, they earn the revenue from premiums and income earned on the float. And the float is just all the premiums that they brought in that have not yet been paid out as benefits. Now, at some point, those premiums just simply become profit, become retained earnings. But they do maintain a large asset investment portfolio to offset their liability portfolio. Insurance companies can be categorized as property and casualty, we'll shorten it to P&C, and as life and health, we'll shorten that to L and H. The liability structure and the payout structure of property and casualty is more variable than life and health. Life and health is more predictable. The products differ between the two in terms of their contract duration and the variability of claims. When we say contract duration, think about an auto insurance policy. It lasts 1 year, and then you renew, and it lasts 1 year. Same with any tenancy insurance, any house insurance, etc. Whereas term life, even something as simple as term life, might be for a 5 or 10 year period. All right, let's walk through property and casualty, and a lot of the comments in this segment apply to life and health as well. So life and health is only 2 screens long. We're going to take 4 screens to get through property and casualty. So let's look at how we would go through an analysis of an insurance company. Let's start with the business profile. Well, property and casualty, right? Property, buildings and autos. Casualty, typically liability to a third party. Can be either personal or commercial. Some insurance companies don't do any commercial at all. They only do personal. Some do both. The model of sales can either be direct or agency writing. Direct means the insurance company has their own sales staff and marketing staff, which means they have higher fixed cost. Agency writing means they're using agents or brokers, so lower fixed costs, but of course it'll cost them more per policy and commissions. They have higher variable costs. Earning characteristics. Business is cyclical and is price sensitive. And the reading makes a distinction between something called a soft pricing market and a hard pricing market in terms of the profitability of the industry. When profitability is high, the industry is described as potentially having a soft pricing market because it attracts new entrants into the market, which drives price down because it is price sensitive, it is cyclical, and it is very competitive. So as prices for premiums start going down, that's described as a soft pricing market. We say that prices are soft. They don't seem to be able to hold up on their own, to the point where some insurance companies simply disappear because they can no longer make money at those lower pricing. Then profitability in the industry starts to increase again. That's described as having a hard pricing market. So as was sort of, I think, clear on the previous screen, the underwriting cycle is driven largely by the expenses of the participants. If new entrants are entering the industry, it drives premiums down, but it doesn't do a lot for expenses. It doesn't drive expenses down. Expenses will be what they are. So the underwriting cycle tends to be driven more by the expenses of the participants. We can look at something called a combined ratio. This is the total insurance expense over net premiums earned. And if we look at the combined ratio from an industry perspective, in other words, aggregated across the industry, if the combined ratio is low, it indicates that there is a hard pricing market. If the combined ratio is high, it indicates a soft pricing market. And if it's greater than 100%, it indicates an underwriting loss, which makes sense. Let's take total insurance expenses across the industry, let's say of 110, and net premiums earned of 100. So we can see that's greater than 100%. Our expenses are 110, our premiums earned are 100. And this is on an industry-wide basis. On a company-by-company basis, some may have a combined ratio higher or lower than the industry average. In the U.S., there's a peculiarity when it comes to the combined ratio. In the U.S., insurance companies must prepare their financial reports according to statutory accounting rules. And these will differ from GAAP and IFRS. And statutory accounting rules define the combined ratio as the sum of 2 ratios. One is the underwriting loss ratio. The other is the expense ratio. And to get the combined ratio, you simply just add them. You'll take one ratio, you'll take another, and you just add them together. The underwriting loss ratio are your losses divided by net premiums earned. This is an indicator of the quality of your underwriting activities. And the expense ratio is underwriting expenses divided by the net premiums written. This is an indicator of the efficiency of a company's operations in acquiring and managing underwriting business. So this is what it costs you to get the business, and this is what it costs you to have that particular business. So when you add the two together, you get a combined ratio, which then tells you what your total insurance expense are, all the losses from the insurance policy you have, plus all the underwriting expenses you went through, divided by all of the net premiums earned. All right, we're going to see more ratios at the bottom of the screen here. In fact, there's our combined ratio right here, and here are the two ratios we just discussed on the previous screen. We'll see, I'll get more into detail about those in a second. Let's look at the loss reserves. And these are reserves that an insurance company would put aside against policy losses. So I collect $1,000 in premium against a particular policy, but there may be a payout. And I have to look at all my policies and say, well, how much should I set aside for that kind of thing? Underestimation may lead to undercharging for risks assumed, simply because I can't price my premiums correctly because the loss reserves become part of my cost. And it is subject to management discretion. Before we go any further, let's take a walk through Exhibit 28. So in this particular exhibit, there's no big grand point that's being made, and there are no questions associated with it. It's just to have a familiarity with this whole idea of loss reserves. So let's see what we have here. Here's the loss reserve balances and activity at and for the year ended December 31st in millions, 14, 15, and 16. Gross claims and claim adjustment expenses, expense reserves at the beginning of the year. So at the beginning of 2016, we have 48,272, and of course that's in millions. What this is saying is this is total claims that we have reserves set aside for total claims and the adjusting expenses to those claims, because whenever there's a claim, an adjuster has to go out, and the adjuster then determines what the amount of the claim is. Well, you got to pay for that, right? So this is your claims and claim expense. So we have a reserve, or Travelers has a reserve of 48,272. Less reinsurance recoverables on unpaid losses. It's very typical for insurance companies to offset some of their risks by saying, you know, we have too much of a concentration of risk in this particular area. They'll contract with a reinsurance company, and they'll get insurance against that insurance that they've written. So this shows that 8,449 is covered by a reinsurance agreement, so that the net reserves at the beginning of the year are only 39,823. Estimated claims and claim adjustment expense for claims arising in the current year. So of all the policies we sold this year, let's put aside 15,675 against what we estimate to be expenses, the claims and claim adjustment expense against that. But look at this. Estimated decrease in claims and claim adjustment expense from claims arising in prior years. So we overestimated in prior years. We're going to take back 680 of that. So our total increase to our reserve should be 14,995. So the 39 on a net basis, the 39 would increase by 14,995. Then we have claims and claim adjustment expense payments for claims arising in the current year. So we say, well, we think 15,675 is a good estimate of what it'll cost us based on everything that we sold. We've already spent 6220. We've already satisfied that much in claims, so we're going to deduct it from the reserves because, well, we put aside money for that in this 15,675. We paid it out. And in prior years, 8,576, we've paid that out. So the balance forward would have included loss reserves from prior years. Well, we've paid out claims against prior years, so we'll reduce our loss reserves by that much. So total payments were 14,796. We can see that we're going to increase our loss reserves by 14,995 and decrease it by 14,796. Almost flat for the year, right? Let's just keep going here. Unrealized foreign exchange gain, 74. And if you just add up all of those net reserves at the end of the year, 39,948. That's the net. We have some reinsurance during the course of the year, 79.81. Add that back on to get our gross claims and claim adjustment, 47.929. And from the gross amount, what we can calculate is a percentage of the total amount that is reinsured. So we just put the reinsurance recoverables, 79.81, over the total gross amount. 16.7% of our gross loss reserves are covered under a reinsurance agreement. So below you have some observations based on the exhibit the exhibit we went through. So we'll just read a couple here. The 2016 claims paid of 6220 is 39.7% of the estimated claims, and claims adjustment of 15,675, indicating that a major part of Travelers Company's liability exposure is fairly short term. So that's an interesting conclusion. The two prior years show a similar exposure term. The company employs significant levels of reinsurance to control its risk exposure. In reinsurance, one insurance company transfers or cedes a portion of its risk to another insurer for a premium. The ceding company expects to recover its losses from the reinsurer. As the table shows, Travelers has been ceding between 16.7 and 17.6 of its gross loss reserves to reinsurers, and we see that here, 17.6 in 2014, 17.5 in 15, 16.7 in 16. What other points does it make? The total increase in loss reserves, net of decreases in claims and claim adjustment expense for prior year's claims, affect the income statement more than any other expense. In 2016, the 14,995 of total increases in loss reserves represented 63.6% of the 23,572 million of total claims and expenses in the income statement, which is not presented here because of space limitations. So we can see that 63.6%, you can start to see if that number is subject to management discretion. There's a lot of opportunity in there if need be, right? I think we can stop at that one. If you want to read more of the points, I invite you to do that rather than me reading through them. All right, before we get into our profitability ratios, let's make sure we understand what these two terms mean: net premiums written and net premiums earned. Net premiums written are direct premiums written minus any reinsurance premiums paid. And net premiums earned, this is just on an accrual basis. So let's say that it is September and here's December 31st, and I take out a 6-month policy and I'll pay for the 6-month policy. Well, that's a premium that's written on this date, but as of December 31st, only half of it is earned. So the net premiums earned are on an accrual basis. All right, profitability ratios. The first one, loss and loss adjustment expense ratio. This is our loss expense plus the loss adjustment expense divided by net premiums earned. Measures the degree of success in estimating risks insured. The lower, the better. I think that makes a lot of sense. Your numerator is how much you had to pay out on all those policies plus the cost of actually calculating what you have to pay out on those policies divided by the premiums that you did earn. Next is the underwriting expense ratio. So it's our underwriting expense over the net premiums written. And underwriting expense is just the cost of actually writing the policies. It's not the cost of owning the policies. This is the cost of owning the policies. This is the cost of actually writing the policies, sales, marketing, commissions, etc. Measures the efficiency of money spent in obtaining new premiums. So if we add 1 and we add 2, we get the combined ratio. 1 plus 2 above measures the overall efficiency of an underwriting operation. Number 4, we have the dividends to policyholders ratio, or it could be to shareholders. And here you'd have to know that insurance companies can be structured either as publicly traded companies or as mutual companies. And more mutual companies are turning into publicly traded companies. It's a process called demutualization. But the biggest mutual company, I mean, if you've been around on this planet long enough, and when you were a kid on a Saturday morning, everybody watched Mutual of Omaha's Wild Kingdom, right? Well, that's a mutual company, right? Dividends paid, so the policyholders actually own the company, so any dividends would flow to the policyholders. But policyholder and shareholder aside, it's dividends paid. So the dividends ratio is just dividends over the net premiums earned. It's a measure of liquidity in terms of, well, do you have enough to meet those dividends? relates cash outflow to the premiums earned in the same period. And number 5 is the combined ratio after dividends. And all we do is we just take the combined ratio and we subtract whatever number 4 is above, whatever percentage you get here. So for the first ratio, the loss and loss adjustment expense ratio, you might get 62%, let's say. For the underwriting expense ratio, you might get, let's say, 29%. So you add them up and you get 91%. That is your combined ratio. And let's say that this dividends to net premiums earned, let's say you have a 3% yield over the net premiums. You subtract the 3%, you got 88%. So that's basically how those 5 ratios come together. Investment returns, C. Oh, sorry. Let's look at Exhibit 29 because Exhibit 29 actually gets us through that. I missed that one. So here we are, and we have a number of different companies that we're going to look at here. Here's the first ratio, the loss and loss adjustment expense ratio. Our numerator is loss expense and loss adjustment expense. Denominator is net premiums earned. So here's our loss and loss adjustment expense ratio, 61.4, 82.2. That's pretty high, right? 61.1, 76.1, 53.1. Very, very low down here. The underwriting expense ratio, underwriting expenses across here, and net premiums written along the bottom down here. If you look at the top, net premiums earned versus net premiums written, some of them are very close, some of them are sort of far off. So if we look at Berkeley here, 62.93, 64.24, they're very, very close. And here's your underwriting expense ratio, 32.6, 48.8, 37.3, etc. Add the two, 61.4 plus 32.6 is 94, 82.2 and 48.8 is 131. So you just look across here. Well, what companies are losing money, right? CNA Financial, that's over 100%. Hartford Financial, 131%, which is the most profitable, well, I shouldn't say the most profitable one, which has the best combined ratio so far. It is Marco Corporation, 89%. Here's the dividend to policyholders or shareholders ratio, 3.1, 2.4, 2.9, 11.7, and 0, nothing over here. And then you just subtract it. 89 minus 0 is 89. 116 minus 11.7 is 104.3. 98.4 minus 2.9. And there we go. So we can see that the two companies that were still in a loss position are still in a loss position. And the best one still, what was our last one? Marco Corporation is still the best one. All right, that's our earnings characteristics from the main business that we're in, which is writing policies, collecting premiums. We also have investment returns. So let's have a look at that. Steady return, low risk assets is what we want to invest in. Investment performance can be measured by total investment income over invested assets. And your numerator can be with and without unrealized gains. Liquidity. You need a high degree of liquidity. You can examine the status in the hierarchy of fair value reporting, and this is for the financial assets that you're invested in. Let's look at Exhibit 31 to add a little bit of context to that. All right, here we are. Portfolio composition by fair value hierarchy, level 1, level 2, level 3, and this is our total column. So of the 100%, look at this, 96.3% in level 2. The first part of the table is for our fixed maturity investments. The bottom part are for equity securities. Equity securities is the other way around, 89.3 in level 1. And that makes a lot of sense. They're publicly traded equity securities. You're not going to take on a lot of risk, so chances are you're going to be in large cap, heavy dividend paying companies. Well, you have a closing price every single day. Probably tight bid-ask spreads. You can trade in and out of these fairly quickly. Whereas fixed maturity securities, if you're going to get any kind of yield, you have to move away from just Treasury securities. And we look at the first category, U.S. Treasury securities and obligations. Notice they're all level 1, very liquid securities. But in the fixed income field, once you move away from Treasuries, they tend to get very illiquid very quickly, especially corporate securities or corporate fixed income, because the issue size is very small. Compared to what the Treasury market would be, it's very small. And it's not uncommon for 2 or 3 funds to pretty much hold all of a particular corporate bond issue. So for many corporate bonds, they don't even trade in a year, not a single trade in a year. So if we look at all of the other fixed income securities, obligations of states, municipalities, political subdivisions, very small issues that they tend to float versus U.S. Treasuries, all level 2. Debt securities issued by foreign governments, all level 2. Mortgage-backed securities, collateralized mortgage obligations, so MBS, CMO, and pass-through security obligations, 1704, all level 2. All other corporate bonds, all level 2. That's not surprising at all. 96.3% of all the fixed maturities are level 2 in the fair value hierarchy. Look at level 3, 0.3%. Just some corporate bonds in there that probably had a decent yield, probably nice and secure, but probably extremely illiquid. However, the insurance company probably has the full intention and the full ability to hold it right to maturity. For equity securities, again, it's the other way around. And finally, capitalization. Here, no global standards exist like they did when we looked at banks. However, various jurisdictions do have their own capital standards. All right, let's move on to life and health. I think we can be rather quick on this side. Business profile, life and health insurance, and investment products and services. And of course, they also follow a direct or agency writing model. The starting place when analyzing life and health insurance companies begin with an understanding of the sources of revenue. And I think Exhibit 7 is a nice thing to look at. Sorry. Did it again. I meant example 7. Revenue diversification, Exhibit 32 and 33 present selected income statement information from 2 different insurance companies respectively. So let's look at the first one, 2012, 2016. Amounts based upon IFRS, premium income, investment income, fees, commissions, and other, and there's our total revenue. We can see that premium income is the largest category. Investment income is second largest, with fees and commissions third. For MetLife, 12, 13, 14, all the way to 16. Again, look at premium income. It is the largest one. Investment income, second largest. And finally, we have the policy fees and other types of revenue for our total. Based on the data for 2016, Exhibit 32 and 33, compare the company's diversification across revenue sources. The easiest way to do that is, as they show here, is just put everything in common size. So everything is just a percentage of everything else. Premium income, 65, 67 roughly, 66, 67, 69. Investment income, 28 down to 23. And fees and commissions, 64, 66, 71. Pretty close, around 7%. This seems to be very close between the 65 to 69%. Here we're anywhere from, well, this is very variable. The investment income has been dropping over the years. And if we look at MetLife, 55 to 61, so a lower proportion of MetLife's income come from premiums. 28 down to 21, same thing we see for investment income, a significant drop as a percentage. And for product policy fees, 15.4 to 17.3, a slight increase on that one. And what is the second question here? Based on the data in Exhibit 32 and 33, describe the trends in each company's diversification across revenue sources with specific reference to premium income. So making specific reference. Well, I think we can look at that right away. Our first company, 65 to 69, so a greater proportion of its income came from premium income, which is what you want to see. That's what it's in business to do, right? And a greater proportion of its income came from fees and commissions. If we look at MetLife, 55 to 61, same thing there. 15.4 to 17.3, same there. Less reliance on investment income. Let's move on. Look at earnings characteristics now. The major expense item, this should come as no surprise, benefit payments. Also, we should be aware a number of items do require significant amounts of judgment. We've been through a reading dealing with defined benefit pension plans, and we saw the amount of assumptions involved in getting that done. Well, life insurance is kind of the same thing. You need an idea of life expectancy. Where are we today versus where do we expect the payout to happen? Annuities come with a whole bunch of assumptions as well. Some specific profitability measures. we've already seen the combined ratio, and if you look at the numerators here, it's sort of the same thing. Our denominator is net premiums written plus deposits. Here we have net premiums written plus deposits. Deposits simply because life insurance does more than just sell insurance. It also has investment products, so there are deposits as well. Total benefits paid, and on the other ratio we have commissions and expenses incurred. So this is the cost of getting the business, and this is the costs of having the business. So if you add them together, you have a combined ratio. Investment returns. Here, the key aspects you'd be looking at: diversification, performance, obviously, and performance can be measured with investment income divided by invested assets. And the big one, interest rate risk. Here you're looking at the duration of the assets versus the duration of the liabilities. You do a lot of this at level 3. Let's walk through example 8. All right, the investment portfolio. Exhibit 35 presents information on the investment portfolio of AIA Group. AIA's portfolio of financial investments constitutes 82% of its total assets, and 84% including investment properties. So we have loans and deposits, and you may be wondering, well, if it's an insurance company, why are there loans and deposits? There are certain life insurance policies that policyholders can borrow against, depending on where interest rates are. When interest rates are really, really low, it makes sense to borrow against those policies at those interest rates and invest outside of the policy at higher interest rates. So that's what that represents. Debt securities, and look at the proportion in debt securities, 73% versus equity securities, 20%, which is different than what we saw in property and casualty, where equity securities were very, very small. Because life insurance policies have, the liabilities with life and health insurance companies tend to be much longer, you can invest in assets that provide a higher return. You can take on a little bit more risk. Derivative financial instruments, very, very small amount. A lot of this is probably going to be interest rate derivatives. So total financial investments, 97.5%. Investment property, 2.5%. And if I had to guess right off the top, I would say the investment property is probably the buildings that they're currently in, along with a bunch of other rental units in the same building to offset the cost of the rental expense and their administrative and overhead. So let's see what else we have here. Investment returns. Interest income, it should be the biggest component. Dividend income, 654. Rental income, 140. Investment income, if you add them all up, we get to 6,084. Gains and losses, 1,471. Total investment return, 7,555. Of the 1,471 million in gains and losses, approximately 127 million was related to debt securities. Number 1, based on the information in Exhibit 35. Describe AIA's investment allocation in 2016 and changes from the prior year. Well, let's have a look at what our changes were. Loans and deposits went from 5.1 to 4.6%. So right away, without really thinking or reading very deeply into the notes or the financial statements, I would probably say, well, loans and deposits have gone down. Most likely interest rates have gone up over that period of time from November 15th to November 16th. Over that course of year, interest rates did rise, so, well, that would probably lower the amount of outstanding loans. Debt security, 73.3, no change there at all. Equity securities, 19 to 19.5, small increase in exposure to equity securities. No change in derivative financial instruments, 97.4 versus 97.5 for total financial assets. Overall, this is there doesn't appear to be any significant change in the asset allocation. Let's see what conclusion is arrived at here. The portfolio, which is mainly invested in debt securities, shows a very small shift from loans and deposits to equity securities in 2016. And it's not the idea of the loans shifting or lowering their exposure to loans. I really don't think that that was a strategic, conscious decision on the insurance company's part. It was just a matter of, listen, as interest rates rise, it doesn't make sense to borrow against your policy anymore. You may as well replace that money. And putting that money back It didn't look like they wanted to change their allocation to fixed income securities, so it just simply went into equity securities. I really don't think that that was any shift in any kind of strategy at all. Number 2, based on the information Exhibit 35, estimate the return on average fixed income assets. For the purpose of this question, consider loans and deposits and debt securities as single class of assets, namely fixed income assets. And we have to be aware here this 127 million was related to debt securities. So if we look at our interest income, this is the only one we're concerned about, 5290 plus the 127. So let's see what we have. The return can be estimated as investment income on fixed income securities divided by the average investment in fixed income securities. The investment income on fixed income securities equal interest income plus gains on debt securities. There are the two numbers, 54. And we're using averages simply because, well, we have a certain number at the beginning of the year and at the end of the year, but money didn't go in right at the beginning of the year, probably went in over the course of the year as premiums came in. So it was probably a uniform distribution over the year. So an average in that sense is probably the way to go. So what do we have? 116,265. So therefore the estimated return on the fixed income investment was 4.7%, which is overall quite good. All right, in assessing liquidity, we should note that the liquidity needs of an insurance company are driven by its liability structure. You're going to see a lot of this at level 3, and when I say quite a bit of it, that's not an understatement. You're going to see quite a bit of this. Sources of liquidity could be just from operating cash flows as that comes in, or you may have to move into your investment assets and get a certain amount of liquidity there. Measures of liquidity is some form of a ratio of assets over liabilities, depending on how the numerator and denominator are defined for particular measures of liquidity, but they're all some form of assets over liabilities. Capitalization, no global standard either. It varies by jurisdiction. We can say this though, life and health insurers typically have lower capital requirements than property and casualty. The L&H claims are more predictable, so they need less of an equity cushion. That wraps up this reading.